Welcome to Talk Tickers. Today we're digging into Mercantile Bank Corporation's Q2 2025 results. And it wasn't just about the numbers this time. There was a really significant strategic announcement, too.
Absolutely. A solid quarter on paper, but the market reaction was, well, let's just say it evolved through the day. We need to unpack why that happened. It's all about their strategy and the guidance they gave.
Right. So let's start there. Headline numbers looked great. GAAP EPS was $1.39, right? Handily beat the non-$1.24 consensus.
Yep. Strong beat.
And net revenue also ahead at $60.9 million versus about $60 million expected. That's, 7.4% year-over-year growth.
Exactly. Compelling figures. And you saw that reflected initially, right? Pre-market, the stock popped.
It did. So why the turnaround? The stock actually closed down nearly 2% by the end of the day. What gives?
Yeah, this is such a classic case study. The market's always looking ahead. That pre-market jump, maybe 2.5%, that was the celebration of those great Q2 results. Past performance. But then, as the call went on, as analysts digested the details, especially the forward guidance and the specifics around interest rate sensitivity and the merger timeline, that initial excitement just kind of evaporated.
Oh, so future worries outweighed past success.
Precisely. The market got a much clearer, maybe more sobering picture of the potential headwinds alongside the upside. Hence the slide to close down about 1.8%.
Got it. Okay, let's dive deeper into that Q2 performance then. Net interest income, NII, up 5.1% year over year, $49.5 million.
That's solid.
But the net interest margin, the NI, that's what caught my eye. It actually stabilized at 3.49%, up 2 basis points from Q1. How did they manage that when so many others are struggling?
Yeah, that NIM piece is probably one of the core strengths this quarter. Management was very clear about their deliberate approach. It wasn't luck.
Okay.
They talked about, careful deposit mix management, using matched funding strategies, and importantly, an active interest rate swap program.
The swaps.
Exactly. Those were crucial, they said, to cushion the blow from the Fed rate cuts we saw back in late 2024. It's like playing defense effectively against falling rates impacting their loan yields. Very strategic management there.
Okay, shifting gears a bit, non-interest income, that really jumped, up 18.4% year over year to $11.5 million. Was that just a one-off or something sustainable happening there?
Good question. It looks pretty broad base, actually. Not just one thing. Mortgage banking was strong, up over 23%, which is impressive given the rate environment.
Yeah, definitely.
They also saw a big recovery in their interest rate swap income compared to Q1. And then, solid growth in treasury management and payroll fees, plus service charges, both up nicely.
So signs of successful diversification, building those fee streams.
Exactly. It seems less reliant purely on lending spreads.
What about the balance sheet? Asset quality looked, pristine. Non-performing assets super low, $9.7 million, just 0.16% of total assets. And they even had net recoveries.
Yeah, recoveries of about, 0.01% annualized. That's incredibly clean. Shows strong underwriting and risk management discipline holding up.
And they made progress on the loan-to-deposit ratio, too. Brought it under 100% from 107% a year ago.
Right, backed by really strong local deposit growth, up 13%. That's key.
And how significant were those energy tax credits you mentioned? That lowered the tax rate quite a bit.
Very significant for the quarter. $1.5 million in transferable credits brought the effective tax rate down to just 12.9%. It's smart capital management. Shows they're looking for efficiency everywhere, not just in core banking operations.
Okay, so operationally strong, managing margins, growing fees, clean balance sheet. But then came the really big news. The EFIN acquisition.
Yes, Eastern Michigan Financial. That definitely shifted the focus.
Tell us about that deal, the nuts and bolts.
It's valued at about $95.8 million, a mix of cash and stock.
Yeah.
They're aiming to close it late Q4, maybe around November 30th or year-end, assuming regulators sign off.
And the strategy?
Classic in-market consolidation. It pushes Mercantile into Michigan's thumb region. The main goal seemed to be grabbing those stable EFIN deposits, boosting overall liquidity, and ultimately lowering their combined cost of funds. They really talked up EFIN as a clean, profitable, culturally aligned partner.
Makes sense.
Yeah.
What about the financial impact? What are they projecting? Management
is guiding for about 11% EPS accretion once it's fully integrated. That's pretty significant.
Oh, yeah.
There's some upfront dilution, though, about 5.8% tangible book value dilution.
Okay, can you quickly remind listeners what that means?
Sure. Tangible book value dilution is basically the immediate hit to the bank's net worth per share after you strip out goodwill and other intangibles created by the deal. But they expect the increased earnings from EFIN to earn back that dilution in about 3.6 years.
Got it. 3.6 years earned back. That sounds reasonable for a deal like this.
It's generally seen as a solid time frame, yes.
And there was that interesting side benefit too, right? EFIN's experience with Jack Henry systems.
Yeah, that's a fascinating, almost hidden synergy. Mercantile is moving to Jack Henry as their core provider in early 2027. EFIN already uses them, has for decades. So that institutional knowledge inside the acquired bank should make Mercantile's own conversion much, much smoother.
Huge. Core conversions can be notoriously painful.
Absolutely. It de-risks a major operational project down the line. It's a really valuable intangible.
Okay, so we have the solid Q2, the big merger announcement. Let's tie it back to the guidance. How did management frame the outlook for the rest of 2025, and which parts specifically seem to worry the market?
Right. This is where the nuance comes in and likely explains that stock dip. For INAM, they see continued stability, guiding 3.50% to 3.60% for Q3, and then ticking up slightly to 3.55% to 3.65% in Q4.
Okay, that sounds positive.
It does. Loan growth, they see 1% to 2% in Q3, partly held back by some expected large CRA loan payoffs, then accelerating to 3% to 5% in Q4. Longer term, they're sticking to their 5% to 8% annual target.
And non-interest income, that big Q2 jump won't repeat every quarter, presumably.
Correct. They guided for that to normalize, maybe settle into a $9 million to $10 million per quarter range for the second half, which is still healthy, just not the blowout level of Q2. They stressed it wasn't a negative signal.
And taxes going back up after the Q2 credit boost.
Yeah, they expect about 16% federal rate in Q3 and 19% in Q4, factoring in some more but smaller energy credits.
Okay, all that seems pretty straightforward, maybe even cautiously optimistic. So what was the specific detail that spooked investors enough to override the good Q2 news?
It really seems to be two key things they quantified. First, the rate sensitivity. They explicitly stated that each 25 basis point Fed cut would likely trim their NII by about 3 to 4 basis points near term.
Putting a number on the potential downside from future cuts.
Exactly. It gives the market something concrete to model against potential easing. Second, it was about the timing of the EFIN merger benefits. Those cost savings, the $5.5 million they projected, aren't hitting all at once. It's phased.
How phased?
About 50% realized in 2026, and then over 90% only by early 2027.
Okay, so the full accretion is a little further out.
Right. And the market is notoriously impatient. So immediate rate sensitivity plus delayed full synergies likely combine to temper that initial enthusiasm.
Makes sense. Management did stress they'd been patient, waiting over a decade for a partner like EFIN. And their long-term plan sounds very focused. Drive local deposits, get that loan-to-deposit ratio down towards 95%, rely less on wholesale funding.
Absolutely. It's a clear blueprint, less reliance on broker deposits, using those sticky local deposits from their expanded footprint to fund growth. It's about building a more resilient, predictable earnings stream for the long haul.
So stepping back, what does this mean for an investor looking at regional banks today? How does Mercantile stack up?
Well, the environment is still tricky for regionals, right? Funding costs are still elevated for many, even as deposit cost increases slow down. But Mercantile seems to be navigating it better than some peers. Actively managing the balance sheet, that focus on local deposits, keeping credit squeaky clean. It positions them relatively well.
What are the key catalysts we should watch for now?
Definitely the EFIN merger close, getting regulatory approval and hitting that late Q4 timeline. Then tracking the integration and seeing if those cost savings start to materialize as projected.
Okay.
The recent dividend increase to 38 cents is also a positive signal, shows confidence. And obviously, future earnings calls will be crucial checkpoints, especially watching MEM trends and loan growth post-merger. The whole story is about this balance sheet reset, adding EFIN, and aiming for steadier, fee-supported earnings heading into 2026.
All right, let's shift to our This Is Not Financial Advice segment. Time to put on our hypothetical hedge fund analyst hat and pitch some, let's call them outrageous but plausible trade ideas based on this call. Okay, pitch number one. A leverage long play on Mercantile, ticker MBWM, maybe using long-dated, out-of-the-money call options.
Okay, leveraged. What's the thesis?
The thesis is the market overreacted to the near-term rate sensitivity and the synergy timing. It's underappreciating the core value here. The strong accretion from EFIN, the proven MM management, the growing fee income.
And the outrageous part.
Betting that regulatory approval comes fast and the integration goes better and faster than expected. Basically a bet that management underpromised and will overdeliver on the synergy timeline, causing a sharp repricing higher.
Okay. Risky. Relies on execution timing. What's pitch two?
Pitch two is a pair trade. Short the regional bank ETF, KRE, and go long MBWM.
Isolating Mercantile's strengths against sector weakness.
Exactly. The KRE faces broad uncertainty rates, deposit competition, you name it. But Mercantile has shown a clear playbook, managing them, diversifying fees, using smart M&A for deposits. So you hedge the overall sector risk while trying to capture Mercantile's specific execution alpha.
Makes sense. Capitalizing on relative strength within a challenged group. Plausible if you believe Mercantile's specific story.
All right, that wraps our speculative segment. Remember, folks, purely hypothetical ideas there. So to sum up our deep dive on Mercantile's Q2, strong results overshadowed somewhat by guidance and merger details, but a clear strategic direction is emerging.
Absolutely. It really shows you need to look at the whole picture, the past results, the future strategy, the guidance, the market context. Especially in banking, understanding those forward-looking statements and management's plan is just critical.
And for you, our listener, here's something to chew on. Mercantile found its EFIN moment after a decade of waiting, focusing on deposits and a clean fit. As rates perhaps stabilize or even fall eventually, and balance sheets maybe look a bit better across the board, which other regional banks might be positioned for their own strategic move, and will they follow Mercantile's disciplined, deposit-focused blueprint or pursue different M&A strategies?
Good question. The M&A landscape could definitely heat up again under the right conditions.
Indeed. Thanks for tuning into Talk Tickers. We hope this analysis gave you some valuable insights. Let us know your thoughts. We always like hearing from you. Until next time, stay informed.